Good afternoon. Despite steady improvements in vaccination rates, stronger confidence, and better global economic growth, the COVID-19 virus continues to weigh on global prospects. Vaccination rates are lagging in many emerging market and developing countries. Until populations develop sufficient immunity to curb virus transmission, waves of infection are likely to continue. As indicated by South Africa's public health authorities, a third wave of virus infection is currently peaking. Additionally, by raising uncertainty and reducing investor confidence, the recent unrest in parts of the country is likely to slow our ongoing recovery. Lockdowns and other restrictive measures that remain in place in a number of countries will continue to weigh on economic activity, particularly in sectors dependent on close contact, such as travel, tourism, hospitality, and leisure. The International Monetary Fund's April forecast for global gross domestic product for 2021 is 6% and will be updated later this month. The Sarb's forecast for global growth in 2021 now sits at 6.1%. For 2022, we expect global growth of 4.4% and 3.4% in 2023. Recoveries in emerging markets and developing countries are expected to lag those in advanced economies, in large part due to slower pace of vaccination. Although policy settings in advanced economies remain accommodative, the spread of the Delta variant, higher global inflation, and uncertainty about the normalization path for interest rates continue to cause financial market and capital flow volatility. This is reflected in persistent risk aversion, especially towards emerging market economies that fail to take advantage of improved global prospects or run large macroeconomic imbalances. The domestic economy grew by 4.6% in the first quarter of 2021, much stronger than the 2.7% expected at the time of our May meeting. That outcome reflected better sectoral growth performances and robust terms of trade. Commodity prices have remained high, sustaining income gains despite higher oil prices. However, recent unrest and economic damage could have lasting effects on investor confidence and job creation. We estimate the unrest to have fully negated the better growth results from the first quarter, resulting in an unchanged estimate of 4.2% for growth in 2021. The direct and indirect costs of recent events will likely further slow South Africa's economic recovery. Although some sectors, notably mining and manufacturing, have largely recovered to pre-pandemic levels, production remains muted in sectors harder hit by the pandemic and in regions now affected by the unrest. The bank's investment forecast was revised up for this year, but remains constrained. Household spending is still expected to be healthy, in line with better than expected salaries and wages, rising asset prices, and low interest rates. GDP is expected to grow by 2.3% in 2022 and by 2.4% in 2023, unchanged since the May meeting. Overall, and after revisions, the risks to the medium-term domestic growth outlook are assessed to be balanced. High export prices, stronger household incomes, and a somewhat better investment outlook are backed up by generally supportive global conditions despite ongoing financial volatility. Recent events in the country their impact on vaccinations, a longer than expected lockdown, limited energy supply, and policy uncertainty pose downside risks to growth. The current account surplus remains substantial and reflects good growth and higher prices for exports, still moderate prices for imported oil, and slowly reviving demand for imported consumer and investment goods. This surplus is expected to give way to a modest current account deficit by next year as exports slow and imports accelerate. Although financing conditions have improved and fiscal risk has eased, the yield curve for rand-denominated bonds remains steep. Long bond yields have returned to pre-pandemic levels of around 9% on 10-year bonds. The generally favorable global conditions and strong commodity export prices have kept the currency close to its long-run equilibrium level, with a year-to-date appreciation of 4% on a trade-weighted basis. Since the May meeting, the rand has depreciated by 0.5% on a trade-weighted basis. The implied starting point for the rand forecast is 14 rands 40 cents to the US dollar, compared with 14 rands 46 at the time of the previous meeting. At a global level, a wide range of prices is accelerating, including raw materials, intermediate inputs, and food, reflecting both global supply shortages and rising demand. So far, this has had relatively limited pass-through to consumer prices. Our estimate for inflation in the G3 economies was revised slightly higher for 2021 to 2.2% and lower in the outer years. Oil prices are revised up, and petrol price inflation is sharply higher at 15.3%. Local electricity prices are unchanged at 10.6%. Headline consumer price inflation for 2021 is revised slightly higher to 4.3% and revised lower to 4.2% in 2022. For 2023, headline consumer price inflation remains unchanged at 4.5%. The forecast for core inflation is revised lower to 2.9% in 2021 and to 3.7% in 2022. Core inflation is expected to be 4.3% in 2023, unchanged from the May forecast. The bank's forecast reflects higher food and petrol prices that push up near-term headline inflation before moderating in the latter half of this year and into 2022. Compared to the May meeting, the current growth forecast implies a wider output gap in the near term. While economic activity strengthens over the forecast period, the current exchange rate level and modest growth in unit labor costs contain the expected rise in core inflation. The risks to the short-term inflation outlook are assessed to the upside, despite weaker than expected services inflation outcomes in recent months. Rapid global producer price inflation and supply shortages created by disruptions to local logistics networks increase these inflation risks. Food price inflation, already very high globally, surprised to the upside in recent months. Petrol, electricity, and other administered prices also continue to present short-term risks. Average surveyed expectations of future inflation have increased by 0.3 percentage points to 4.2% for 2021 and by 0.2 percentage points to 4.4% for 2022. Market-based expectations for inflation are slightly higher for 2021 and lower over the longer horizons. Given the medium and long-term projections set out above, a weaker currency, higher domestic import tariffs, and escalating wage demands present longer-term upside risks to the inflation forecast. Despite higher inflation expectations and continued upside risks, the committee expects inflation to be contained in 2021 and 2022 before rising to around the midpoint of the inflation target range in 2023. Against this backdrop, the MPC decided to keep rates unchanged at 3.5% per annum. The decision was unanimous. The implied policy rate path of the quarterly projection model indicates an increase of 25 basis points in the fourth quarter of 2021 and in each quarter of 2022. These repurchase rate levels reflect a highly accommodative policy stance through the end of 2022, keeping financial conditions supportive of credit demand as the economy recovers from the pandemic and associated lockdowns. The bank has ensured adequate liquidity in domestic markets and will continue to closely monitor funding markets for stress. In addition, regulatory relief provided to banks continues to support lending to households and firms. Better anchored expectations of future inflation could keep interest rates lower for longer and can be realized by achieving a stable public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage inflation low into the recovery. Such steps will enhance the effectiveness of monetary policy and its transmission to the broader economy. Economic and financial conditions are expected to remain volatile for the foreseeable future. In this uncertain environment, policy decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on second round effects. As usual, the repo rate projection from the quarterly projection model remains a broad policy guide, changing from meeting to meeting in response to new data and risks. This concludes our statement, and we will now turn to the media for any questions that you might have. And as usual, please identify yourself and the name of the media house that you represent, and I will then direct your questions to as appropriate to members of the panel.
Thank you, Governor. We've got a couple of questions from Funeko from Business Maverick. At what, if any, point does macroeconomic stability alone cease being sufficient gauge of the effectiveness of monetary policy and how it interfaces with other fiscal policy? Do you believe the negative...
Wait. Did you say macro policy or monetary policy?
Monetary policy.
You said macro, okay. Get it, Okay, now you can repeat the question.
At what, if any, point does macroeconomic stability alone cease being sufficient gauge of the effectiveness of monetary policy and how it interfaces with other fiscal policy? His second question, do you believe the negative real rates can still be maintained? Do you see the recent unrest and violence being a lasting impact on growth prospects and the output gap? And what impact has it had on the country's risk? One last question from Funeko. What have you observed to be the relationship between inflation and economic growth expectations recently, but also extending to the period since early 2020 when the pandemic struck? Is the relationship still where faster economic activity begets higher inflation expectations, or has the dynamic been fundamentally altered by COVID-19? Those are the questions so far, Governor.
It's just Mfuneko who asked questions. No other questions from anybody?
For now, yes. Others are still coming in.
Okay, thank you very much for those questions. Macroeconomic stability is a necessary but not a sufficient condition for growth. And macroeconomic policy is in the main two levers, being fiscal policy and monetary policy. Fiscal policy is the preserve of the Minister of Finance and the executive. We do not opine on fiscal policy. We only take account of the effects of fiscal policy to the extent that it impacts on the risks to the outlook, and in particular, how the fiscal policy settings affect the country risk premium and thus, by extension, the long-term interest rates in the economy, which basically then means that they fit into the cost of capital. Monetary policy's remit is that of price stability. And in pursuing price stability, monetary policy also seeks to stabilize output around its trend and around potential. And to the extent that there is deviation from that, monetary policy becomes effective. But let us understand that monetary policy horizon is that of a period of 12 to 18 months. Monetary policy cannot affect the structural growth or the potential growth rate of this economy. We only affect the cyclical growth, and hence our role, the role of monetary policy as a stabilization policy. And I guess that Mfuneko also deals with your question about the interrelationship between inflation and growth. And you said that does higher growth, is it still the case that higher growth leads to higher inflation? No, it had never been. Growth leads to inflation only if growth is higher than potential. So if you have got accelerating growth and yet growth is still below potential, it can't be inflationary. But let's take it the other way, Mfuneko, and say that higher inflation is detrimental to growth. For you to get sustainable growth, you have got to have price stability. And that is where monetary policy settings comes in, and that is where a framework like we are having of a flexible inflation targeting becomes important in managing fluctuations of growth around potential, and thus ensuring that you have got less volatility in growth and in interest rates. Negative rates, we do state that our monetary policy setting at the moment is accommodative. And we think that it is the correct policy stance to take. We do highlight, however, that there are risks to the inflation outlook. And should these risks materialize, we may have to reduce accommodation. Actually, the repo rate path that is embedded in the quarterly projection model does state that we will have 25 basis points increases starting from the fourth quarter of this year all the way into the fourth quarter of next year. Just a guide from the QPM. In the end, the MPC looks at all the factors and all the information at its disposal and then pronounces on an appropriate monetary policy stance. So forget whether interest rates are negative or positive in real terms at the moment. We consider the monetary policy stance now as appropriate, as being consistent with the economic conditions that we are facing as a country. There are risks to the economic outlook, and should the risks threaten to materialize, the MPC will not hesitate to act true to its mandate, utilizing the tools at our disposal. Impact of the unrest is too early to tell. There is no doubt that the unrest had disrupted supply chains in South Africa and affected our logistics framework. There is no doubt that it had had an impact on investor confidence, both domestic and international. The country is now on a path to clean the ravages from the unrest, and we just hope that the authorities, within whose power it is to quell these events, will do as appropriate and make sure that we actually restore normality, and by extension, hopefully bring back investor confidence. Has it had a rise in the country risk premium? Not at the moment that we have seen so far, but it could have down the line. But as it stands now, we have not seen an impact on the country risk premium. Ziyanda?
Thank you, Governor. Olivia from Reuters has a question, but you've already responded to it. It was the impact of last week's unrest on the nation's GDP in the third quarter. Pranisha from Bloomberg, she's asking, it's a similar question, but she's asking what kind of impact did the unrest last week have on the bank's GDP growth and inflation forecasts? When do you see output returning to pre-pandemic levels? Pranisha's second question, can you please explain the difference between the short-term and long-term risks to inflation? What do upside risks but still contained mean? What do you see as the current neutral rate, and what's the gap between that and the repo rate? We've got a question related to currency management from Nico at The Economist. Are there any other strategies in addition to staining with ink banknotes to combat the use of the looted banknotes? Those are the questions for now, Governor. We've got others, but those are the ones for now.
Thank you very much. Prior to the unrest, we were destined to revise our growth forecast for this year higher. In the aftermath of the unrest, we couldn't revise our growth any higher. But we have decided to keep it the same. We were going to revise our growth higher because the starting point of the forecast was higher as a result of the first quarter GDP figures coming out higher than we had expected, just over 4%, and our expectation was that of 2.7%. And that is the effect that we had on the GDP. In terms of GDP returning to pre-COVID levels, our baseline is that it is still going to be somewhere in 2023. But as the world is opening up, and if we continue with prudent macro policies and we actually implement some of the structural reforms that government had actually announced, we might see that period for 2023 shift around maybe by a quarter or so being brought forward. But our baseline is still that we will only return to pre-COVID levels in 2023. Now it's for time for me. Rashad, you are going to deal with the stained banknotes, and whilst you are at it, deal with the neutral interest, real interest rate, and the gap between that and the repo. At the moment, as we had said, we are still accommodative. Chris Logal, can you deal with the short-term and long-term risks to inflation? She wants to know what the differences are, but I thought that we had spelled out which ones are short-term and which ones are long-term. If you could use your skill as a pedagogue to explain that, please. Rashad?
Thank you very much. Thank you very much, Governor. Yeah, on the neutral rate, I mean, current calculations of the domestic neutral rate are in the region of 2.1%. So based on that, you can see that the actual real neutral rate, which is basically the repo rate plus 1 year ahead inflation expectations, is far below the domestic neutral rate, which is the equilibrium neutral rate. So when we say we in highly accommodative mode, we say that based on the calculation of the domestic neutral rate, we're below that. Now, obviously, at some stage there are big debates about what has COVID done to the calculation of the equilibrium neutral rate. Does it have some kind of upward bias, downward bias? Increasing public debt may have an upward bias. Low propensity for desired savings may bring a lower bias in the neutral rate. But just a simple answer to your question, it's in the order of about 2.1% neutral real rate. Yes, on the stained notes, yes, of course. We have a team out there. We have a highly geared up quality control team in the note company, who obviously would strongly discourage the use of notes if you think that these notes are stained, because it means they were illegally acquired. But I think that the bank will continue to give more information on as we get more information on stained notes. We'll continue to direct the public on what to do with stained notes. Thank you very much.
Thanks, Rashad. Chris?
Thanks. So short-term versus long-term risks. So the short-term inflation trajectory is shaped very much by much higher petrol prices and considerably higher food prices than we had expected. And our view remains that there are still some risks to food prices going up a little bit higher. It's not in our forecast, so our forecast has food prices moderating going forward. But the point is that global food prices are very strong and the exchange rate's very strong. So if the exchange rate moves in the other direction, we could get that passing through into higher food price inflation in the short term. Petrol prices is a similar dynamic. The long term is a bit different. I mean, the long-term inflation forecast is primarily shaped by a quite modest unit labor cost trajectory alongside an output gap that is closing at a fairly slow pace. And the exchange rate remains quite high also, which feeds through into low imported goods price inflation. And so the risk there is that all three of those turn adversely, so that you get more depreciation in the exchange rate, higher unit labor cost inflation, and a faster closing of the output gap, all three of which would push up inflation in the longer term of the forecast. Thanks.
Thank you. Zianda?
Thank you, Governor. We've got two questions from Hilary Joffe. She says, can you provide more detail on the extent to which the supply chain disruption caused by last week's unrest might impact inflation? Her second question is, you've said you would support reducing the inflation target. What timeline would you envisage for this? What would be the ideal conditions in which to do so? We've got a question from Siphelele Dludla at Business Report. What is the governor's view on government's decision to destroy the looted goods because they will have an economic impact on the legitimate goods on the market? Our next question is from Artwell at Alliance News. The US Federal Reserve has made some hawkish comments recently, signaling monetary policy may tighten sooner than expected. Is this something the Sarb is worried about, given that the bank hasn't started normalization yet, and some emerging market central banks have started raising rates? We've got another question from Lucanio at Business Day. The governor said that inflation expectations anchored at a lower rate will help keep interest rates lower. Are there any prospects of the bank changing its messaging, which the market currently sees as preference for inflation around 4.5%? Does the bank believe it should be anchored below that? Can I read a last question from Naledi Ngobo at SABC? To what extent did the recent social unrest threaten monetary policy, if at all, and what kind of policy interventions from a fiscal perspective can be used to reverse the impact to the economy? There are more questions, Governor, we can take in the next round, if you don't mind.
Okay, thank you very much. Naledi's question is a very straightforward one. The social unrest didn't threaten monetary policy. In terms of what fiscal measures to be taken, that is 240 Madiba Street, the National Treasury can answer that. Fundi, you are going to deal with the question about the Fed, and then Siphelele, the thing about the destruction of the loot instead of returning it, it's not for us to deal with here in the monetary policy, not even in the Sarb for that matter. Hilary, your two questions. Firstly, the impact on inflation of the recent disruption in the supply chains. It's a big if, and if this holds and this doesn't hold, it's a very uncertain thing. There will be a lot of guesstimates there. What we do know is that anecdotal evidence showed that where people were engaged in panic buying, that in some instances, price setters began to increase some of the prices, almost in the black market. There have been anecdotal evidence of what had happened to the price of bread and all of that. But those supply chain disruptions had been restored, and so it's going to be a guesstimate. There are areas where infrastructure got destroyed, whether it is the warehouses of the chain stores, or whether it is the shopping centers themselves and so forth. Again, it's going to be a function of whether the insurance picks up the cost and so forth, and if it doesn't, would the people pass the cost over to the consumers? And if the insurers pick up those costs, they might increase insurance premiums. And if they increase the insurance premiums, do the stores absorb the increased premiums, or do they pass the cost to the consumers? Too early to tell what that impact is. And that is why we only highlight it as a risk. If we knew what that risk, what exactly the impact is, we would have just taken it into account into our decision making. Your second question relates also to what Lucanio had said about the anchoring of inflation expectations. Let's be clear. There is no virtue in high inflation. Higher inflation begets higher interest rates. There is an inflation target range that we have agreed to between the Minister of Finance and the Sarb. And it is a target range of 3 to 6. Over the years, there were times when the actual inflation outcome was closer to 6% than it was to 3%. We took a conscious decision in 2017 to say, we would like to see inflation expectations anchored around the 4.5% level, which is the midpoint of the inflation targeting range. And as such, when we were able to sustain that for a protracted period of time, inflation expectations came down. And when we were hit by the coronavirus shock, we had the policy space to provide support to households and firms because inflation expectations were anchored. And we saw that being sustained. And now we have had a period of around 30 months where inflation expectations are anchored at the 4.5 and somewhat below the 4.5. This is good for South Africa because that means that we are able to continue to provide the accommodation as is required by this economy. Let me also be clear about the point that you have raised about the reduction of the inflation target, that there is nothing that would stop us from going from a lower rate within the target range. We have just not been engaged in that conversation as yet. But we know, and we have been in engagement with the Treasury, that there is a macroeconomic review that is taking place. And amongst those could be what we do with the inflation target. South Africa was amongst the first 11 countries or so to introduce inflation targeting in 2000. And we introduced that target as a target of 3 to 6 at the time. And by 2001, that target was revised lower to 3 to 5. We experienced a shock and inflation overshot the target. And between the Reserve Bank and the Treasury, we decided that we should revise the target back to 3 to 6. That was a big policy mistake. What should have been done was to keep the target the same and rather state that it will take us this long to come back within the target. Because then what that did was that it seemed to engrave in the price setters' minds that should there be a shock, there will always be a revision upwards instead of gearing back towards the shock. That there is a review of macroeconomic policy, and that that could also involve a review of the inflation targeting framework, does not necessarily mean that the inflation targeting framework would change. But if it has to change, it can't be that the target goes higher. It can only go lower. There have been a number of reviews across the world at the moment, both in Canada, the US, the UK, the ECB. They all had a review of their monetary policy anchors. They all came back and they said, oh, no, they are at the 2% level. Amongst the emerging market universe, the gravitation of inflation targets is closer to 3% rather than closer to 2%. But from the bank side, as that process goes on, we will engage with that process. And and hopefully there will be an announcement that the Minister of Finance and the Central Bank agree to. The technical work was previously done, by the way, and it was done, and there was an exchange of letters between Minister Manuel and Governor Mboweni at the time. And when we experienced that shock in 2001, the announcement that was made was that at an appropriate time, we will reinstate the 3 to 5% target. The problem was that both of them moved and nobody remembered that we said at an appropriate time that could be done. Once again, there is no virtue in high inflation. Higher inflation begets higher interest rates. And higher inflation is an enemy of people who want fixed income, is an enemy of people who are relying on fixed grants from government because it erodes their buying power. And lastly, inflation that is higher than that of our competing countries is not good for the competitiveness of this economy. Fundi?
Thank you, Governor. So let me respond to the question about the communication from the Fed. So what the Federal Reserve Bank and the discourse in the US is about whether the current higher inflation that they are experiencing is temporary or permanent. So in the same way that we as the MPC have a discussion about the risks, this is what you're seeing in the communication from the Fed. There are members within the Fed itself that are worried that this inflation might be higher. So that's what you're seeing. But the official communication from the Fed and the line that they have been clear about is that they see inflation in the US as being temporary, and that inflation expectations remained anchored and they remained fairly contained. Now, that doesn't mean that in financial markets there is not going to be a response, because investors overall look to interest rate signals from the major central banks so that they can price in the type of risk and so that they can price in also the types of returns that they're looking for. So there is that is happening, which is happening simultaneously. So as the Reserve Bank, we do not preempt the actions of the Fed. We rely on what is the official communication of the Fed. But we do, however, continue to watch what is happening in financial markets, because if markets are pricing in that there are going to be higher interest rates in the United States, and they start to price that into which types of assets they want to invest in, that will have an impact on South Africa. We are reliant on capital inflows, and a lot of those capital inflows either go into shares or they will go into purchases of government bonds. So that is an area that we are keeping a very close eye on as the Reserve Bank. And we have signaled this in our statement, and we will continue to communicate on this going forward. But the indication from the Fed so far is that rates will start to go up around 2023. So the discourse is about a longer term horizon, but the market reaction is generally immediate. Let me stop there.
Thank you, Fundi. Back to you, Zianda.
Thanks, Governor. I think this might be our last round. I've got a question from Alex Winning at Reuters. There's a lot of focus in the markets at the moment on the dollar. It is expected to stay strong or get stronger, which could be difficult for emerging markets. For some, the discussion has shifted from a temper tantrum to a dollar tantrum. How resilient does the Sarb think the rand will be in the face of a stronger dollar? We've got a question from Pranisha, which Deputy Governor Fundi has already covered, but it just goes a little further than what was previously asked. The market is anticipating Fed tempering around year-end, and a number of emerging central banks have embarked on tightening cycle or adopted a more hawkish tilt since the Sarb's last MPC. Are you concerned about falling behind the curve by holding rates steady? Are you concerned that the country could actually see disinvestments due to your stance? And then another question from Pranisha relates to the inflation target. She's basically asking if there are any conversation between the Sarb and the Treasury or the Sarb internally. And she follows on to say, would you be in favor of keeping a target range, or would you advocate for an explicit mandate change to a single point target with a tolerance band during such talks? And if so, what would be an optimal or reasonable point target? Question from Mfuneko. You've already answered it, Governor, on inflation target. And then he extends to say, you say in the statement that the bank could keep interest rates lower if public debt was stabilized lower. Between last year and now, have you observed any improvements in government debt levels and the forward trend? Are you still concerned about concentration risk with commercial banks holding large amounts of government bonds? Has this concentration affected demand in weekly repo auctions? Two more questions, Governor. One is from Nico at Economite. He says, a question on the monetary policy transmission mechanism. Has it been affected since the pandemic hit? Our last set of questions is from Pranisha at Bloomberg. Governor, you talked a bit about how coordinated policy actions could help economies emerge from COVID-19 crisis at a recent Russian central bank event. Could you please explain why you're in favor of this, and also tell us a bit about how coordination works in the common monetary area? There have been rising calls from local and foreign investors, and even by the JSE, calling for the removal of all capital controls in South Africa, saying they were diminishing the country's attractiveness to investment. Does the Sarb still see value in keeping current controls? And what proposals do you think are needed to make the laws more alive to investors' needs currently? Those are all the questions, Governor. Thank you.
I can see all monetary policy questions have been exhausted. And now people are scraping on things that have nothing to do with this. DG Naidu, if you could deal with the issue of falling behind the curve and the concentration of risk, that would be Pranisha's question, and also the removal of capital controls, if you could deal with that. Fundi, if you could deal with the transmission mechanism since the pandemic, whether it still works, and also deal with the focus on the dollar risks. And then I will conclude by dealing with the issue of policy coordination. Let's start with you, DG Naidu.
Thank you, Governor, and thank you for the questions. Governor, I never know how to answer these questions on falling behind the curve, right? I mean, it's one we get asked often, you know, I never know how to answer them. But let me make the following point. Monetary policy is always a balance of when to turn, right? There's always an issue about the timing of the turning. We recognize that monetary policy would have to tighten over the next 3 or 4 years. We recognize that interest rates may have to go up over the next 3 to 4 years. The precise timing of that is essentially a function of how the economy performs, how inflation evolves, how inflation expectations evolve. We think that we are in a fortunate position at the moment for 3 or 4 reasons. One is inflation's largely been low for the last 3 or 4 years. While it's above the target, the midpoint of the target now, we're projecting it to go back below the midpoint of the target in the near term. That gives us space. The fact that the budget deficit is reducing and is consolidating certainly adds to the space that monetary authorities have. But again, you still have a very large budget deficit in absolute terms. The fact that we've got a current account surplus means you're less reliant on the dollar, you're less reliant on dollar inflows. That provides us with a degree of space. But Chair, there are other risks, right? There are risks around food. Chris has highlighted some of those risks. There are risks from foreign CPI. There's risks of currency weakness as the dollar starts to strengthen, as the Fed normalizes. All of those things are risks. So, we think at the moment we should keep rates on hold. This is not a question of falling behind the curve. This is a question about timing that increase in interest rates appropriately given the state of the economy. Concentration risk. You're talking, I think Mfuneko also asked a question about the bank holdings of government debt. It is a concern if the banks hold large amounts of government debt, because if government gets into trouble, if there's a fiscal problem, it could impact on the financial sector. That is not a major concern for us at the moment. The increase in bank holdings of government debt is largely predictable. It's largely a function of where we are in the cycle, in the economic cycle. When you go into a recession, there is always an increase in precautionary savings. There's an increase in deposits and a reduction in demand for credit. So the banks have additional liquidity, and they've used some of that liquidity to buy government debt. The government borrowing requirement is increased, and so that adds to that. We don't see this as a problem. If in the next 2 or 3 years, the banks are still the main funders of the government deficit, that would pose a problem. But we're nowhere near there. And we believe that we've got the prudential, micro and macro prudential tools to deal with that risk if and when it arises. Exchange controls is essentially within the policy domain of the Minister of Finance. It's a delegated function to the Reserve Bank, but it's in the domain of the Minister of Finance. In short, I would say this: some exchange controls work and some don't work. I think we need to get rid of some, but I think we would want to maintain some. Right? As an emerging market, I think that there are some exchange controls that are needed. It is important to have a prudential limit on how much pension funds can invest outside. It's important to have a prudential limit on what the banking sector can borrow in terms of dollar or foreign currency finance. There are many exchange controls that I don't believe work, and I don't believe works effectively. And we are in discussions with the Treasury as part of the OECD process of simplifying our exchange control regime, of modernizing our exchange control regime, all of which were announced by the minister in last year's MTBPS. Let me leave it at that, Chair.
Okay. By the way, can we just state that there is a global standard on how open your capital account is, and it is a code that is issued by the OECD, and South Africa had actually been in a process to comply with that code. Should we comply with that code, that would mean that our management of the capital account is consistent with what is being seen globally. Lastly, is that there has been an increasing interest in the management of these capital flows, so much so that you even had the IMF come with what is called the institutional view on capital flow measures, and that increasingly the issue of capital flow measures is being used to manage issues of financial stability. What is in no doubt for us in South Africa is that we have made such significant progress in the liberalization of the capital account that I actually do not think that it is an issue anymore. So we'll leave it there. And Fundi?
Thank you, Governor. So let me start with the question about whether the transmission mechanism still works. And my answer is that the transmission mechanism indeed still does work. You will not see, however, huge moves in credit numbers because we are coming through, or we're coming out of a recession, and we are in the middle of this COVID crisis right now, where companies have had to deal with significant losses of revenue, where individuals have lost employment as well. So what we are seeing is that households and businesses are a lot more cautious in taking out debt. In fact, what we have seen is a lot more savings. But there are some indicators that are useful to look at in terms of understanding whether the actions taken by the Sarb have had an impact. So we have seen an increase in mortgage take-up for first-time home buyers. We have also seen during the course of this year some increases in mortgage take-up for people who are even investing in second homes. But this will differ across different income groups. And of course, those who are not in a good credit standing will not be able to take up additional debt and loans. So you can't look at the credit numbers purely and say, well, the credit numbers are not going up, and therefore there has not been a good transmission from a monetary policy point of view. We certainly have seen an impact. The second layer of monetary policy impact is what has happened in the broader wholesale money market, which is the market where corporates themselves, banks lend each other cash, and also a market in which government itself has borrowed money. So we have seen in that market that as the Sarb has reduced interest rates, those wholesale borrowing rates have also come down, which means there are some savings and there is transmission to that market as well. We saw during the course of last year, the National Treasury switched some of its lending from longer term to the short-term space in order for them to take advantage of lower interest rates in the short-term lending market. With regards to the focus on the US dollar, I think it's important for us to just look at why is the dollar seen to be likely to strengthen over time. It's because of the point that I made earlier, where market participants are expecting to see an increase in interest rates in the US. There is also an expectation that the US government will be issuing a lot more US treasuries, and that would imply that investors are likely to see the US as a very good investment market. And what that implies for emerging market countries like South Africa is that investors are likely to have a preference for keeping their funds in the US. So we might see some capital outflows, which is where the impact on currencies like the Rand might be. But as we look at whether the Rand is resilient or not resilient, it's quite important for us to remember that the Rand is a price that reflects a number of things. It reflects the policy settings in the country. It reflects the growth outlook in the country. It also, of course, does reflect the attractiveness of the country as an investment destination. So the interest rate differential between South Africa and the US will matter. But broadly, what we have seen is that the Rand as a currency is quite resilient. And when our policy settings are correct, and when our interest rate differential with the US is quite healthy, we do see a movement of capital in and out of the country. And the Rand is quite robust in making this adjustment. So during the course of last year, we saw the rand weaken a lot in the second quarter. It rebounded quite strongly as we saw the return of capital flows to the country. So the rand as a currency is a good buffer in terms of pricing in the risks that are out there in the market. So let me stop there. Thank you, Governor.
Thank you very much, Fundi. There was a question that had come in earlier in the chat from Hillary about the QPM and why what is the point of the QPM if we ignore it. We can't outsource policy making to a model. The model is but just one input. And so let's also be clear that the QPM is a steady state model. It can't assess risks. The assessment of risks is the responsibility of members of the MPC. And so while the QPM could say this is the policy path that we see, we should be able as the MPC to assess the risks attendant to the forecast and take an appropriate policy decision. Otherwise, we shouldn't be having the MPC if all that the MPC would do is to follow the QPM. But even as you have said, even if we were to follow the QPM, who said we are ignoring it? Because the QPM is only forecasting a rate hike in the fourth quarter of this year. It's only July now. And so at every meeting, we will assess our forecast and we will assess the risks and the balance thereof, which risks are in the immediate, which risks are in the medium term, and whether the policy stance that is attendant at the time is an appropriate one or not. And if it is not appropriate, we will adjust the policy to deal with the risks that might be emerging. So let's be clear. In every statement of the MPC, we state that the QPM is just but a guide. It is not what the MPC is going to be doing. The MPC will take that as one input, and the members of the MPC will express views about the balance of risks to both growth and the inflation, and then take an appropriate policy stance. Prinasha, your question about coordination. Last year, when we were hit by the policy shock, the response of the South African government was firstly to respond to the health shock through containment measures of the spread of the virus. And appropriately, the response was a health one. And as the pandemic evolved, it was clear that it is hitting the economy as there needed to be response. Those who respond on the basis of their institutional remit. And our institutional remit is that of price stability and, by extension, smoothing the output variations around potential. And so at the time, the shock showed that the South African economy was going to contract and was going to fall, the growth rate was going to fall significantly below potential. And so the monetary authorities acted. This was a coordinated response to the pandemic, with every institution within our governance structure acting within its policy remit. We didn't tell the Treasury what stimulus, how much stimulus they must provide from the fiscal side, and neither did they tell us what we should be doing from the monetary policy side. We also took steps from the regulatory policy side, and that made coordination easy because both financial regulatory instruments and monetary policy instruments are within the control of the Sarb. And so the Sarb was able to deploy its monetary policy instruments, its microprudential instruments and macroprudential instruments, including taking appropriate steps to make sure that liquidity returns in the market. That is coordination. As the world opens up, a big discussion amongst policymakers is at what stage would the extraordinary measures be withdrawn? And in withdrawing those extraordinary measures, there are two important forms of coordination. The first one is a global one. The deviation from or international standards, or rather not the deviation, the utilization of flexibility within the international standards was something that was also discussed within the Financial Stability Board, so that we evaluate that jurisdictions are exercising the flexibility within the standards that are globally agreed. It then goes without saying that when that withdrawal of those extraordinary measures takes place, that global coordination also takes place. Global coordination is actually pretty difficult because you do not have a global government. Every jurisdiction acts on the basis of what they see in their own economy. And so there is the global coordination and there is the local coordination. On the local side, I have spelled out what was done last year. And in a similar way, when you have to withdraw the extraordinary measures, every institution will have to act within its policy remit, which is what, as the central bank, we would actually do. You asked the question about the CMA. South Africa is the anchor economy. And you will realize that the other central banks in the CMA will wait for the central bank, the South African Reserve Bank, before they make their own policy pronouncements. But besides that, there are things where we have to agree, like the introduction of deposit insurance. Given that is the common monetary area, you can't introduce deposit insurance in one jurisdiction and not in the others. Because if you do that, deposit will move to where there is deposit insurance. If you have got to have a policy on the capital account, you have got to have an agreement on that, because if you don't, you are one common area, then you will not be actually able to act in unison. And that is the kind of coordination that one talks about. I think that it is important to understand that coordination does not mean that one institution instructs another to act in a particular manner. But coordination says, this is the policy intent. Do what you have to do within your mandate, using your instruments to pursue that policy intent. But you will not be able to say, do this or do that. Thank you very much, Zianda and members of the press. Thank you very much for attending. That concludes the proceedings of today. Back to you, Zianda.
Thank you, Governor.